Right.
And they
We
all
good?
goes together.
Right.
Are we good here?
We're good.
Okay, we'll go ahead and call this meeting to order. Roll call.
When
Nellie, who's gonna do roll call? Okay.
When I call your jurisdiction, or yes, if I call your jurisdiction, will you please state your name? Belmont,
Bob McCune.
thank you. Burlingame,
Donna Colson.
East Palo Alto, Los Banos,
Michael Amabill.
thank you. Good morning. Redwood
Good
City.
morning.
Owen Martinez.
Wonderful. Thank you so much. And we have a quorum.
Great. Just. Our government is killing me right now. Okay. We are going to have public comment. If anyone would like to make public comment at this time, we have one more.
Great.
Hello, hi Mark. Fine. Is there anyone I don't see anyone here that would like to make public comment. Is there anyone online, Nellie or Brianna?
No, there's not.
Okay.
Mayor Amabill has joined as well.
Okay, great. We have Mayor Emma Bell, and I'm going to give just 1 second here for Mr. Dinan to join us too.
There you go. All set.
You good? Right. Okay. Can I have an action to set the agenda and approve the consent items? The 2 items on the consent calendar are the Audit and Finance Committee meeting schedule and the approval of the minutes from September and November Audit and Finance Committee meetings. We weren't able to approve those because we didn't have quorum at the time. And, or we haven't had a meeting since then, I'm thinking. But if anyone has any issues on the Finance Committee meeting dates, you can pull the calendar and we can take a look at that. Anyone? All right, seeing none, can I get a motion?
I will say
Oh,
just,
yeah, please.
in this, to be respectful of everyone's time, we did reduce the number of meetings by 1. So we found a way to only get by with 5, so hopefully that's well received. Still,
Yeah,
it's still
we're-
covering everything we need to.
Thank you. Perfect, all right, so we have a motion, we have a motion by McEwen,
Second.
director by Martinez, a second by Martinez, or first names here, 'cause it's casual, Tom and Elmer. Do we have anyone participating online?
We do. We need a roll
Okay.
call.
We need to do a roll call vote?
Yep.
Okay,
Belmont,
Aye.
Burlingame,
yes,
East Palo Alto,
Yes.
Los Banos,
Aye.
Redwood City.
Yes.
Motion passes.
great. Okay, staff report. Nick, you're gonna give us an update. on a few
Yes.
things.
Morning, everyone.
Thank you.
Morning, Nick.
Morning.
Morning, Nick.
We get the presentation up here, sorry.
Okay. Are we good?
No.
We'll get that up?
It was up a second ago. There we go.
Great, okay. A couple items, some of these are just history, but just, it's been a while since we met, since the last meeting we didn't have a quorum. And then some of these are just moving forward projects, but the first 2 are more historical. The board did approve the rate change at the board meeting at the end of January, and just want to let everyone know that that did get into effect on February 1st. It's actually a lot of work, to be honest, and I give Leslie and her team all the credit for that, but there's a lot of work to be done to get all the different rate schedules updated, but that was done effective February 1st. So our customers are realizing that 47% reduction in their rates, so well received. It'll take a little while for that to get through people's billing cycle, because people get billed at a different day of each month. And then the cash flow will take a while to hit us, so we probably won't start seeing the impact until middle of the month or later in the month, but that is up and running, so good news, hopefully. Second one again is,
Nick?
yeah,
Sorry, just to add a little color there. So it is a 47% reduction in our rates for the net effect of a 10% reduction on a customer's bill. Okay, so that's net of the PCIA exit
Mhm.
fee and PG&E significant reduction as well. So I just want everyone to be clear that
Mhm.
the net effect is 10%, which is
Yeah,
what,
well,
which
it's
is
a 10% discount. It's
Discount,
47%
that's right.
reduction from our
in order to
last rate.
maintain that discount across the bill. So
That's
just for
pretty great.
clarity. Thank you. Uh-oh.
So, stupid question, I should have followed this more closely than I did, but what was the basic reason for PG&E's reduction in rates? What drove that? That were,
So a lot of it was just lower cost of energy that they were able to realize and flow through to their customers.
okay,
Cost of RA down, cost of renewable attributes down, cost of brown power slightly down to a little flat.
okay.
Who knows how long that will last,
Mhm.
right? But that's where we're at today.
And just to be clear, I don't have the numbers in front of me, their reduction was something like a 25%. Because the PCIA increased, we had to reduce our rates by so much more because we basically want to have to net out the PCIA.
That's right.
Second thing, we did close the prepay transaction on December 19th. I think it priced maybe on December 1st or 2nd, but it's an extended close period, so good news there. We won't start seeing the savings from prepay 2 until June period, so we have some time to get all the invoicing and processing done. It was the same thing we did with prepay number 1. There is a time lag, but we will start realizing that savings of about, I think it's 11% starting mid-year. Third one is sort of a moving forward project. Budget process will kick off in March. Haley, who you all know and remember, has been on leave, so she comes back at the end of this month, and that will be her number 1 priority. So we will kick that off in March. That'll run through March, April, May. We'll come back to the Finance Committee in May, and then look for board approval in June. The next one I'll save until later on because there's a whole agenda item on it. We've been spending a lot of time on our banking RFP request for proposal, and so we have a whole agenda item today to discuss with you where we are and get your guys' thoughts. And the final one is, we did this last year, wanted to give everyone just a little bit of an update on how our cash position has performed over the last year. We do have a sizable cash position of almost $500 million. We'll talk about in the second quarter results. Want to make sure, obviously, that we are maximizing return. Although I'll say our number 1 priority is not so much maximizing return, but safety of principal. And so we're not swinging for the fences there. And so we have a whole agenda item here on Carlos, who I'll introduce in a second. But before I hand it over to him, want to just, it's not working. There.
I can't wait for new typing.
I know, I know.
Just to remind everyone, we have 3 external investment managers. This is a structure we put in place 2 years ago, right when Andy left and I joined. The 3 investment managers are CAMP, which stands for California, I think, Asset Management Program. That is a more short duration portfolio. You can see the maturity there of average maturity of 47 days. We view that as sort of our working capital cash needs. It has grown in amount, but that'll be where we'll also start pulling money from as we start funding the rate reduction that I mentioned. And then we've got 2 external investment managers. Carlos is here representing Chandler, so I'll let him talk about his firm and performance in more detail, as well as the market. And then PFM. Last year we had PFM who gave an update, and I like to sort of rotate a little bit, give both firms an opportunity to speak. They manage a little bit of a longer duration portfolio. You can see very similar, but maturity of 2.5 and 3 years. Very high quality, AA rated. The benchmark that they match against is the ICE B of A 1 to 5 year corporate and government index. And you can see last year earned 5.92%. very happy to say that both firms exceeded that benchmark. Carlos a little better than PFM, although that gives and takes each year. And so I think we're really happy with the performance. Camp's return is slightly less than Chandler and PFM because they are shorter maturity and we are back to sort of a normal upward sloping yield curve. So that would be what you would expect. I will say last year it was a reverse. Camp outperformed both Chandler and PFM, which was a little abnormal. And so we're now back to sort of a more market normal environment. I probably wouldn't, well, you never know, but I probably wouldn't expect these numbers to repeat next year. Carlos will talk about that a little bit, but these are very high returns for basically a cash-like investment return.
Yeah, depending on if the rates.
Yeah. So that's our investment management performance. As I mentioned, I invited Carlos Oblites, did I pronounce that correctly, to give us a presentation on Chandler Asset Management. As I mentioned, it's one of the 3 outside investment management firms we've hired to manage our investment portfolio. I'll turn it over to Carlos, but he's going to talk a little bit about the markets, historical and going forward, and then a little more detail in the portfolio specifically that Chandler manages for us. So with that, I will hand this to you. It looks like it's working, so.
I'm just reading
Perfect.
notes.
Well, thank you for having me. I'm one of your investment advisors. My name is Carlos Oblites. I'm a senior portfolio strategist with the investment team. I'm part of the group that makes decisions on how we're going to position these portfolios. I'm but one voice and many voices in that process. As Nick stated, we are one of your investment advisors. Chandler Asset Management has been managing money since, well, we're now close to 38 years. I think that we've been doing this, and I've been personally at this for 31. It's my 31st year of doing this. I think you're all aware the California government code limits what you can do with this money. You're not able to buy bond or stocks, I should say. You're not able to buy private equity. You're not able to buy commodities. Real estate, anything like that. You're really subject to code that's spelled out in California Government Code, section 53601 and the subparagraphs beneath that. And effectively, you're a lender. You are an investor in the bond markets, which are loans. In the bond markets, you make money 2 primary ways in this portfolio. You collect interest income, it's rent for your money, basically. And that cash flow coming to you from the future, when you lend money out, when you buy a bond, you're lending money out and you're waiting for that money to come back. And while you wait, you're getting paid interest. But while you wait, the value of that future cash flow coming back to you can go up and down in value. So the principal and the interest payments have a present value, and that value can go up and down depending on what other alternatives there are in the market. So those are the 2 ways that you make money. You collect interest income, and the fair value of your portfolio can go up and down. Sometimes that value is realized with a sale before maturity. Sometimes it's not, because we may hold the security to maturity. There is an overall strategy that is implemented. That strategy is active. We don't just simply buy and hold all the time. We buy everything with the intent to buy and hold the securities. But when there are times to reposition the portfolio to achieve many things, not just collect a gain, we do it. And we can do that because, unlike the stock markets, in the bond markets, active management is actually, it actually works. You can get into the theory of that. Stock markets are very efficient. There's a lot of information that investors have. Most people tend to index their money. In the bond markets, that's not the case.
I wouldn't agree with that, but anyway.
Most people, but you may index. But generally speaking,
I would say most people on that, and the reason I think it's important, because all of us also oversee in our other lives, actively managed pension portfolios through CalPERS and STIRS. So we have other parts of our portfolios that are actively managed for longer duration liabilities.
absolutely. And of course, we manage several.
And I don't want anybody going back here tomorrow and telling their chief finance officer, everything should be indexed in the portfolio and messing all that up.
And you're absolutely right. We manage several Section 115 trusts, pension remediation trusts,
Yeah.
also post-retirement medical trusts. And absolutely, when I say indexing is, so that active management is usually to manage the overall asset allocation, which is an active decision. Absolutely. You
But also
described it
active
correctly.
stock. Most people have, I mean, PERS have a lot of active stock. They have a lot of index, but they also do a lot of active
Correct.
management too.
Correct.
but on the bond portfolio side, so what you're talking about here is we have a base index and then you're adding value through actively making decisions around that index to be longer duration, shorter duration, more heavily weighted to one set of securities or another, correct?
That's exactly right, and I'm gonna jump, I'm just gonna jump ahead and hit one page, because I wanna make sure that it gets through, because this is important. This is the term structure of your portfolio, as of this past December and as of the last December. The green is in the current December, and the structure of that, the way that we've structured those maturities, every bond has a maturity in your portfolio, it'll come due, your money comes back, and they stop paying you interest. And the structure that you see there is a decision. It's one of the decisions that we make in the portfolio, but it speaks to the strategy quite closely. The strategy, how we structure this, and primarily the average of those maturity allocations that you see up there are the biggest determinant of risk and return. Those are actually durations. It's a little bit different than your maturity. A duration is a risk measure that tells us how the portfolio market value may shift for a given interest rate shift in the markets. And that how you position that is the biggest determinant of risk and return in that portfolio. And so most bond managers, good bond managers, will generally constrain that. It's very difficult to understand if rates are rising or falling, and it's very difficult to call it right all the time. And generally the idea is if rates are rising, you want to be shorter because you're getting maturities coming due faster, which you can then reinvest in increasingly higher rates. And vice versa, if rates are falling, you want to have longer maturities, which hold your yield for longer, and you're not forced to reinvest as quickly as rates in the markets fall. That's the general idea, but no one really knows when rates are going to move, or how far, or to what degree, or when will they start and when will they end. So generally what most managers do is they will look at what on average a certain position or a longer position or a longer position or a longer position, and that target of that average duration, they stick to it, and that is your strategy. And that's what we're doing here. When you average out the green, you average somewhere around 2.5 years. Your investments, California government code generally allows you to go out to 5 years. There are some cases when you can go longer than 5, but most local governments stick to 5 and shorter because it's a good fit, a good asset liability match for their cash flow.
When you say 5 and shorter, you're not talking about duration, you're talking about the 5-year maturity, the outstanding, or are you talking about duration?
I'm talking about, so under the law measures it under maturity, and it's 5-year legal filing. So I can have something with a duration, you won't have something with a longer duration than the maturity,
Of course,
but California government code is organized under the maturity. It looks at maturity, so
Right,
you can't go
so
longer than
I
5.
can't go longer than 5, so you'll never have a duration of longer than 5.
Correct. And your average duration, if we're looking at 1 to 5 years, is going to be somewhere.
Would be something like 2.5 years.
2.5
And
years.
what's the index duration?
It's a 2.5 year index.
2.5,
that
and
moves
you're
as
at
well.
2.5.
Yeah.
So you try to peg the duration of the index, you're not really taking that kind of, or do you guys actively move around the index?
We don't peg it, we constrain it, so we can move around within a band of
Okay,
that duration
got it.
target. So we view
Got
the, of course, as you're aware, the index is a universe of treasuries and agencies. So that the treasuries roll off when they leave it's a 1 to 5 year benchmark. When they get shorter than 1 year, they roll off and shorter pieces come in, so that duration moves around a tiny bit.
Mhm.
So we move around with it, but we really move around based on our decision of where rates are going.
Okay.
Any questions on that? This is a little esoteric, but it's important to understand. We target duration. We try and stick to one duration over the long haul, whether rates are rising or falling, because it's also a marker for how much interest rate risk you're taking on.
Mhm.
2.5 years means your portfolio will shift upwards in value 2.5% if rates fall 100 basis points, if rates fall 1%. And vice versa, if rates rise 1% across the board, you lose 2.5% in market value. The longer the duration, the more volatility. But generally speaking, over the long haul, the more return. That's the approach. And there's an active strategy to maintain that duration within its target. So let's back up a little bit and let's talk about the portfolio, and then I'm going to back into the economics piece of it.
Can I also, say one thing? I just want to make sure we also, since this is sort of a newish committee and we're kind of putting it together. The other thing that's really important to understand is the reason we don't have all our money just sitting in a bank is because when you have your money in a bank, just in a banking account, the FDIC will underwrite that for $250,000 if they can actually pay on it. But you don't own individual securities. What goes on here is, are we in a pooled fund or a separate account?
This is a separate account of
Separate
individual
account.
securities.
Okay, so we're in a separate account, which means that
Camp is a pooled fund, but
in the separate account, we technically actually own our securities. So unlike a bank, if Chandler was to go away, like tomorrow, their whole firm blew up and nobody wanted to work together anymore, we could simply take our securities, claw them back through our custodian bank, we own them, and we could hire another manager to overlay on that. We could also liquidate a portfolio like this very quick because it's highly liquid. We could liquidate it and hire a new manager, or a new manager could take over the securities and transition it to their own feature. But I think it's important to understand, that's why when you get to magnitudes of 5 million, 10 million, 150 million, we don't leave it in a bank. We put it into actively managed for a couple of reasons. One, we're going to make a little more money on it, which in a company like ours can almost fund our operations sometimes. And because unlike the situation you had with Silicon Valley Bank and then First Republic Bank, if you have a bunch of assets just sitting in the bank, all of a sudden now you've got to figure out, like, I've actually got to pull that money out of the bank, and you don't have underlying securities that you own that you can take away. So it's a risk reduction strategy for us as an organization too.
If I may piggyback
Please.
on what you said, and I think there's also a question, but I want to piggyback on what you said, because what you said is really important. A bank, if you leave your money in the bank, it becomes a liability of the bank. It's on the bank's balance sheet as a liability they have to pay you back. Where these are actual securities held at a custodian, which is another bank, it's a custodial account where they hold these assets in your name. So if something happens to the bank, the assets don't get picked over by creditors of the bank, number one. Number two, you do have FDIC for the first 250,000, which you correctly stated. In California, local governments, the state of California requires banks to collateralize any local government investments, okay? So anything beyond the 250,000 has collateral. So you said two things. One thing that's really important, and I add a second one to it. You said you have FDIC insurance over the first 250,000 if FDIC decides to pay, which is always a question mark, okay? And number two, that collateral, this is my addition, that collateral generally tends to be longer dated securities, which are a mismatch to your operation. So if the bank were to go belly up, they pay you off. Eventually, you'd get paid off, but you'd end up with a bunch of 20 and 30-year treasuries or agencies.
Well, no, it's a little bit like, so years ago, there was something called securities lending where banks would come in and say, we can borrow your securities from your pension fund like Samsara or CalPERS, and then we'll lend them out and give you the interest, but you'll always have those securities collateralized with like 102% or 103% collateral. But what we found out was always those collaterals weren't valued correctly often. So maybe it was only collateralized really at like 80 or 90%. And that's the risk that sort of still would happen, even if it was collateralized at a bank, is that they mispriced the collateral and therefore they don't actually have the assets to repatriate to all the people who are banking with the bank, which is different than this, where we have transparency right through to the custodial bank. So if we were to terminate a manager for some reason, there's a huge scandal at your firm or something, or any firm or whatever, we could simply terminate the manager. We'd retain the securities with the, we have a different, we have a relationship with the custodian bank that holds the securities for us. And then we could hire a new manager. So I want to give a kind of an understanding of the framework of the difference between banking and investment management and why we've moved the money out of a bank and into these two investment managers. And why we've used two is because we want to diversify organizations and strategy so that when you amalgamate the portfolios, they're hopefully a little bit different, but it also gives us less risk in the portfolio, in that if someone did have an operational issue or something, we could move the asset, we could invite the other manager to help us manage that portfolio until we transition to a new manager.
It's 2+1 plus camp, right?
Yeah.
Which is a pooled portfolio. And then Nick, just for everybody's level set, I think the sweep that we keep about 20 million in the account. And then it's swept
At the
out.
bank.
So there is,
At the
yeah,
bank, yeah.
yeah. So there is money above 250,000 at the bank, because we have to for operating,
just
like
don't
our payroll and
mass
everything.
Right.
But we don't put 400, 500 million in a bank.
That's right.
We tried to minimize that.
And I think there was a question over there.
Yeah, sorry, this is my first meeting. My impression is that probably 6% is historically pretty high in terms of a rate of return.
It's really
Yes.
good.
So,
Do not.
Yeah.
so like what's typical in the last, 10 years?
In the last 10 years, it's been around some instances, less than 1%, 1 or 2%.
So it's your management genius that.
No.
No.
Uh,
It's
We're denying that he's a management genius. I mean, what is this?
We're a good manager and we know how to add value. We certainly pay for ourselves and then some. But the biggest driver of this is that you're seeing the highest rates that we've seen in about 15 years. If you think about what happened during the global financial crisis, well, let's back up. Let's back up to the dot-com bust, and interest rates fell very quickly. And that was 2001, 2001. They came back up sometime around 2007. You were having shorter rates be somewhere around a little bit 5% range. And then you had the global financial crisis hit at the end of 2008, 2009. The Fed dropped rates and they kept them low for about a decade. And they were basically sub 1% till about 2016, 2017, and they started climbing back up. So you had a period of time when you were not going to get over 1.5% anywhere in the United States. So
That you could argue is abnormal too. Probably like 2 to 3 is over a 30-year sort of normal.
I would say so. I mean, there was a season in my career, and like I said, I've been doing this for 3 decades. There was a season in my career for well over a decade when I was showing up and I was saying, pat me in the back because I just got you 0.5% this year.
Well, and also, we're talking about a very specific piece of the bond market, which is short duration, high quality bonds. If you open up the whole bond market and talked about, you can walk to 30-year treasuries, you can look at really
But we're not.
long, you can put corporates, we can't do that. So, and again, this is another important thing, which is making sure that when people are talking to you about, well, I earned 8% on my bond portfolio or my private credit portfolio, these other styles of bond picking, which allow for riskier bonds, more actively managed bonds and longer duration bonds, they're going to have more return. We have a very specific state mandated, safe, highly
Hyper concerned about
liquid,
losing.
highly liquid, yeah.
So the one thing this can't do is lose money ever.
No, it can lose money, 100%. If you owned a bunch of bonds it did lose money. Oh,
Yeah,
a
couple years ago,
we lost money because if you have a bond that is at 2% interest and rates start moving up, so when rates move up, in order for you to sell that bond, somebody could buy a 4% bond and you've got a 2%. So you have to discount your par value of your bond in order to be able to make it equal 4%. So it's the same as the other one. So you would take I was just saying, costing a loss on, and if it could be a realized or an unrealized, depending if you sell that security or not. So when interest rates go up, bond markets generally can go negative.
We're not talking like Google risk, it's like 1 or 2%.
Yeah. And it might be temporarily negative, like it'll give you a quarter or 2 quarters or even 3 of negative returns. But then once they get the portfolio reinvested in the higher rates, overall, the smoothing and the long-term rates of return and IRRs or time-weighted market, using time-weighted market value of the portfolio, the returns will smooth and overall they'll go up.
So, but for long-term planning, you can't count on a 5% return or
Yeah.
6% return that
Absolutely
would
not.
fund all sorts of stuff.
No.
We can and do work with staff to project what the earnings will look like for this and for next fiscal year. And our estimates are pretty good because we know how to do this. But anything beyond that is suspect. So it's not something that you can really use for capital planning over the long.
So you made roughly like 25 million off of the 500 in the bank last year. Is that like in terms of?
We made about 20. I mean, it grew over the past year, so it wasn't 500 for the full year, but I think we made about $20 million in interest income.
Yeah.
What's the minimum creditworthiness rating on bonds that we invest in?
So California Government Code allows you to purchase as low as the rating category of single A, which is one notch above the bottom of what's considered the best credit, so it's known as the investment grade world. So you can buy single A credits. The requirement is that of all of the three main rating agencies, S&P, Moody's, and Fitch, at least one of them has to be rated at least single A.
Okay. The only time I ever personally made money in bonds was 1986, but I'm not a big fan of
Well, the
bond
rates
investing.
are in like early eighties when bond, interest rates are
15%.
18%. We should have immunized our entire pension
I 100-year
portfolios.
bond.
We all should have just put every pension dollar into
I
18%
tried.
return and let it ride for 18 years, 30 years.
I got a little bit of that actually.
So I do want to mention California Government Code,
Well, then the interest rates fell.
Well, then you
which
made even
caused them to
more
go up in
money.
value.
Yeah.
Which caused them to go up in value.
Made more money.
One thing I do want to mention is California Government Code has a final maturity of 5 years, as we stated earlier, but it is silent on 4 different asset classes where you're allowed to purchase: U.S. Treasury bonds, federal, and the bonds of its federal agencies and government-sponsored enterprises, municipal securities. So these are your cities, your constituent cities that are issuing bonds, and counties and other local governments, and also, funny enough, negotiable CDs, although I defy you to find a CD longer than 5 years. But those three that I'm talking about, the treasuries, agencies, and munis, the code is silent on final maturity. It is silent. And there's another section of code that basically states every asset class has a final maturity. If there's no indication on final maturity, the limit is 5 years on everything, unless the governing body of your local government has given authority to go beyond those 5 years. So the instances where we see that go longer are generally three case study. I'm mentioning this because this is something that maybe in your future, depending on how your cash flows look, there are 3 instances when we really see local governments go beyond 5 years. And there's an advantage to going beyond 5 years, that you generally get paid a higher yield over the long haul. The first is Joint Powers Insurance Authorities, JPAs. So they, especially those that have workers' comp programs, they'll have workers' comp programs where their average duration will be somewhere around 3.5 years. In the bond markets, to get a 3.5-year duration, that's generally going to be a maturity range of 1 to 10 years. Okay, that's one case. That's not you. The second case is generally going to be a water or wastewater district that has long-term projects. They go longer, they have money that sits around for longer, they can tie that money up for longer and get a higher return on it. Again, that's not you. The third instance is where we have local governments that, rather than going all the way up to 10, 20, or 30 years, they have that 5-year limit, they maintain that 1 to 5 year strategy, they keep that 2.5-year duration strategy, but they may purchase just a little bit longer opportunistically. And that we do see more and more of that. And that's something that we may discuss in the future, not today, not anytime soon, but it's just something that, we try and look over under every rock to make sure that we're generating return wherever we can see. If we turn to page 18 and, oh, you're already there, that's beautiful.
Perfect.
This is a good summary of what the portfolio looks like right now. The average maturity, you're in the middle column as of December 31st, as of the end of the calendar year. The column to the right is where you were about a year ago. We started working with you about 2 years ago, almost down to the wire.
Exactly.
But just to give you an idea of how the portfolio has shifted, and this is what I meant. If you look at the middle column, that's where you are as of the year end. The second row is it says the average modified duration. That's that duration number that I spoke about. Right now you're at 2.6 years. 2.6 means that, like I said, if rates rise 100 basis points, if they rise 1%, you lose approximately 2.6% of market value. The opposite happens if they fall 1%. The benchmark is currently at 2.5. That's a deliberate position. We have been positioning you longer than your benchmark. In fact, it's been our strategy since the fall of 2023 to position our actively managed portfolios slightly longer than their benchmarks, because the anticipation was that rates would fall. And that's exactly what interest rates have done. And I can show you a chart on that. As those rates fall, you've held on to your income longer, which means your yield is higher. And also, as those rates fall, the present value, the value of your bonds goes up. If I put on a policymaker's hat like you, if you're a policymaker, you're probably always thinking about this portfolio in two ways. One is interest income, because interest income is spendable, it goes to your budget. And that's something that can be spent on your mission. And then the other side of it is fair value. Fair value, you can't really spend unless you realize it, unless you sell it before maturity. But it is an economic impact to your overall position. Rating agencies look at that if you're issuing bonds. I mean, it moves your balance sheet around. If I put on my accountant's hat, GASB 31, Governmental Accounting Standard Board, pronouncement number 31, has you book that change in fair value on paper against your income on your income statement every year, and your stuff does that every year. Okay. Your yield to maturity is 3.97. Yield to maturity is not your return. That's a rate of at which you are earning interest income into the future based on how you are positioned today. So what does that mean? If I'm driving a car down the highway at 60 miles an hour, if I keep my foot on the pedal at 60 miles an hour and the road is kind of straight, in about an hour, I'm gonna achieve 60 miles and my odometer will collect it. So there's a little bit of a speedometer. At 3.97, it just says if I can't kind of keep earning at that rate, if the maturities are coming, get reinvested at that rate, and if nothing kind of goes away, nothing matures, I should end up with about 3.97 in about a year's time. That's what that really says. Notice that it's higher than it was last quarter. That's because of last year, even though rates have been falling, it's because we have a healthy exposure to yield advantage sectors, which carry a higher yield than governmental securities, although governmental securities do make up a good size of your portfolio. The market yield is that same yield but measured on the date of that report, and it's indicative of what you would get, the yield you would get had you purchased the portfolio on that day. You're not purchasing the entire portfolio on that day, but if you were to have a maturity or new money invested on that day, and we were to invest it to look like the portfolio, that's an indication of the kind of yield that you're picking up on that day. So the way to look at it is you're earning 3.97 and you're kind of reinvesting into a 3.79 world. And that's because rates have fallen. Look at where that rate was a year prior. It was 4.50. That's what the market is offering, and that's on its way down. And that has given you, that's had a dual impact on your portfolio. It's given you a tailwind into your return, because I said that return is two components. The fair value is going up as rates have been falling. And because you're longer than the benchmark, on a relative basis, you're outperforming the benchmark because you hang on to your yield longer than the benchmark. And if you compare that to returns of shorter investments like CAMP, which is a short-term investment, like local agency investment fund, which is a state pool, or a money market mutual fund. Those are all shorter-term investments really meant for like the most liquid asset. Well, you're outperforming all of that because you're longer and your fair value appreciation is higher because you're long. The average credit quality is AA. Right now, we're managing about 143.5, a little bit over 143.5 million. That increased recently. There were some additional allocations to the portfolio.
Do we have a lot more slides?
Here we
No,
go.
I'm gonna keep it real
Oh,
short.
perfect, okay.
There are, but I'm gonna
We'll
keep
get,
it
like,
short.
let's get, I'm sorry, because I've interrupted you too. Maybe 3 or 4 minutes so
Yep.
people can ask questions and we can open it up to the public.
Absolutely. I'm gonna jump up to
Yeah.
one more slide. This is the makeup of the portfolio. I mentioned that governmental securities make up a good size of your portfolio. We're holding about 51% in treasury securities. Typically, you see the second position be federal agencies, but there really just hasn't been any value. You don't get much of a yield pickup. We'd rather have the liquidity of the treasury. So your second largest is corporate bonds, about a little bit over a quarter. We go up to 30%. Those can be rated single A or higher. We do buy pass-through securities. These are pools of receivables. They're known as asset-backed securities, also some federal agency mortgage-backed securities. They're good diversifiers, and our credit analysis capabilities are very well, we have that's one of our strengths, is to be able to analyze those. If I jump ahead and look at the return over the last 12 months was 6.19, which is a very strong return. You really had a fantastic calendar year. That shouldn't always be. I would say that about close to anywhere from 2/3 to 3/4 of that 6.19 came from interest income. The rest of it came from fair value appreciation. This is before our fee. Our fee is approximately about 4 or 5 basis points, 0.05%. So reduce 619 and make it 614, basically, versus the benchmark of 592. So on a relative basis, for the amount of duration risk that you took to achieve this, Well, you did really well. Since we've been working with you over those last 2 years, we've been averaging 5.12 versus the benchmark of 4.79. That 5.12 is the annual average taking compounding into effect. So it's been a very strong portfolio. I would tell you, and this is going to be my last slide, I'm going to back up to the economics piece, is that the Federal Reserve has been lowering rates. You can see how 2, 5, and 10-year rates have been coming down on the chart on the left-hand side. It just means that your reinvestments are going to come into lower yields, and it means your interest income is going to come down. This is true for this portfolio, for your PFM managed portfolio, and I know how they manage money at PFM. I used to work there. I was a director there. They're very good friends of mine. Monique Scott is a good friend of mine. But one of the things you mentioned, Camp. So the Federal Reserve is expected to perhaps lower rates one more time. When they do that, if you look at the chart on the right-hand side, it's the term structure of interest rates. It's the relationship in yield between different maturities from 3 months out to 30 years. When the Fed moves again, it's expected that the left-hand side of that right-hand side chart will drop more, while the longer end will kind of stay more or less where it is. Why am I bringing that up? I'm bringing that up because your shortest investments, that's where they invest. And because they're much shorter, they're going to reinvest in an increasingly lower rate environment. So this is one of the reasons why your staff is carefully looking at the allocation between their longer portfolios and their shortest investments. And because pretty soon, if things continue the way we think they're going to continue, you may see lower income in there. So that's something that staff looks at very carefully. It's very well thought out. You have a very balanced approach to all of this, making sure that you have enough liquidity when you need it. Of course, safety is the primary objective. You're achieving that wholesale here. You've done quite well, and your returns have been quite strong. I'll stop with that. And you
Perfect.
take any questions.
Just sorry, I do want to say, both PFM and Chandler manage from an ESG perspective.
Yeah.
So maybe you could comment on that.
Absolutely.
Since.
While you're getting that set up, I'm gonna just really quickly open, are there any members of the public that would like to make a comment or have questions? We have none. I just want to open it for public comment and shout it. Okay. Open and shout. Great. Okay, continue.
Okay, sounds good. So one of the mandates that you've given us is to, when we make investments, that we factor in environmental, social, and governance related issues. So that when we make our purchases, you have a mission to be dealing with good corporate players. So that's something that we do. We basically get a rating from an environmental, social, and governance perspective from S&P. There are other services that do that. We just happen to work with Standard & Poor's. Of all the issuers that you have, 33 out of the 37 issuers are rated. Not every issuer is rated. The United States government isn't rated. And many of them, the way that they get rated is they have to provide, God bless you, they have to provide information to the rate to that ESG rater. Not all of them do, and sometimes because they don't, they may get rated lower or they don't get rated at all. But you have a good number of them. It's about 64 million of your portfolio, about 45% of your portfolio. You can see who the non-rated issuers are. What I can tell you is we did have a little bit of a dip on the overall ESG score, and that's mainly because of the environmental score. And I can kind of click through. These are the different sectors that's in your board packet, but I'm gonna land right here. The top 5 that went up, well, these are the top by decile. The top 5 you can see are Hyundai Motor Company, Cisco, Air Products and Chemicals, Bank of America, and AbbVie. And then the bottom 5, you can see their insurance companies, Mass Life, New York Life, Freddie Mac, which is a federal agency, JP Morgan, and Simon Property. So the interesting bit about Mass Life and New York Life is those are private placement securities. Because you're a qualified institutional buyer, you're able to purchase into a private placement market called the 144A market or 144A issues. You're allowed to do that, and that's been to your advantage. But because of that, they're not required to release as much information, and for that result, their ESG scores tend to be on the lower end. If I look at who the improvements and the decliners were, AbbVie. I'll just look at the decliners. AbbVie is a pharmaceutical manufacturer. They're being investigated to see how much of what impact was their role in the opioid crisis. GM had some safety failures with their robotaxi business, and Honda. Well, the EU there was an EU violation on restricting competition and recycling. So those kind of they had a drop in ESG scores, and that's why you saw the overall score come down a little bit. Home Depot actually had an improvement, that it was had related to some packaging. Eli Lilly, that there was a fair pricing that they're entering into, you know, that's a bit of an opaque market. And Pensacola had a climate change reduction strategy that's been successful thus far. But this is what I want to say is, this is something that PCE came to us and said, this is a part of our mission. It's important to us that we deal with good corporate players on the environmental, social, and governance stands. And we want a mechanism to be able to rate those and factor that into your decision-making process as you build these portfolios. And this is generally what it looks like.
What's the high end of that ESG ranking? Because I see it like Hyundai is 70.
Correct.
In general, is the highest 100? Is
So-
it 0 to 100 or what's the?
It's so
Oh,
the
I see.
S&P, the S&P score goes 0 to 100, and very few people get scored 100 because a lot of it, as I said, is the ability or the availability of information. What happens is S&P sends a questionnaire out, and the executive teams decide, do we want to answer this or do we not? And many choose not to, or delay it, or won't give full disclosure because it may be disclosures of their strategic plans. It's an imperfect way. It's not like getting a credit rating
I
score.
think the main thing here is just that we're thoughtful about it. We understand what's in the portfolio, and also we don't buy, basically, the main thing we really don't do is we don't
Right.
invest in oil and gas.
Awesome. Yeah.
The fossil fuels.
Yeah.
We aren't gonna own Chevron in this
right.
portfolio. We just can't. So it aligns with the corporate mission. So I think,
Okay.
I mean, that's really good. Does anyone have questions? Yeah, please.
You touched on the Fed. That was gonna be my question. The administration keeps pressuring the Fed to cut interest rates, which they have done a little bit, very slowly, rightfully, in my opinion, to avoid triggering a bunch of inflation. But if they do cut interest rates, that should increase the market value of our portfolio.
Yes.
But it should reduce the earnings, but increase the market value. What the crystal ball, we think they might cut rates a little bit one more time unless there's, what's the crystal ball say there?
So the Chandler view is that the Fed has room to cut rates one more time. And that's generally when they're cutting rates, it's trying to pump more money into the economy. They effectively make it cheaper for investors to borrow money. And then those investors might turn around and invest in their business and expand and hire more people. Remember that they're trying to promote jobs by stimulating the economy. They're usually raising rates when they want to do the opposite. And the opposite is generally because there's too much money and inflation goes up. They're trying to bring inflation down. But to your point, your statement is correct. Your future earnings may come down. Remember that when the Federal Reserve lowers rates or raises rates, it really impacts generally shorter rates. 2 years and in generally the 2-year area of maturities is the most policy sensitive. Longer term rates are really driven by long-term inflationary expectations and also credit quality. Those are staying put because of just a global, I think global investors are trying to digest what it means for the long-term economic growth of the United States and the world with tariffs, with just the current administration. And I would say that the Federal Reserve is poised to lower them because we are where most investors would say we're at the tail end of the business cycle, and employment has been slowing down. And I think the Federal Reserve has been looking for reasons to lower rates. They certainly don't want to do it because they're getting political pressure. There is a new Fed chair, or there will be a new Fed chair. His last name is Warsh. He's a former Fed player. He was known as a hawk, which was somebody that was more inclined to raise rates rather than lower them. He's been brought in. Generally, the markets are viewing his upcoming appointment, which has to be ratified by the Senate. They're viewing his as the quote unquote adult choice. They think that that's somebody that's going to try and help keep that distance between the administration and the Federal Reserve, but that's neither here nor there. That is definitely a challenge that the Federal Open Market Committee and the Fed has. But generally the markets took it as a good sign thus far.
Thank you.
Yeah.
All right.
Okay.
We're gonna
Now you've
let
had your
that
fill
go.
of the bond
We're gonna-
markets.
Yeah, we've got it. No,
Discussion,
no, it's all really great.
I used to work in the Reserve.
Okay, thank you
Thank you,
very
Carlos. Appreciate
much,
it.
Carlos. We really appreciate
Thank
it.
you.
Thank you for running our money. We really are grateful to the firm. And It's been a real nice relationship for 2 years. Thank you very much.
Thank you, guys. We're very privileged to be working with you guys. We're grateful for this.
Thank you.
The work that we've done here. Thank you.
Thanks, Carlos,
We
appreciate it.
appreciate it. Okay, everyone, so we will, that's very helpful though. I think it's a good
Good
start for
context.
our new members. So the next item we have on the agenda is a discussion of request for proposal for PCE General Banking Services. It's a discussion item and I'll turn it over to Nick.
Sure. So wanted to get you up to speed on the RFP that we issued in November. I think I briefed the committee earlier last year that we would be embarking on this process. We released it on November 3rd. We posted on our website. We proactively reached out to banks we know are active in the CCA space, posted on our LinkedIn profile. We got 6 official proposals, which we were happy with. Of those, and the 6 are the 4 that I mentioned here, plus Scotiabank and Heritage Bank. Excuse me. We shortlisted the 6 to 4 who Sean and I met with in person. Did sort of had the banks come in and do presentations. And from those 4, we've further narrowed it down to what we're calling our finalists, which are JP Morgan, who is the incumbent, and River City Bank. And I gave a little bit of background in the staff report, so hopefully people read that, but just to repeat it a little bit. The reason the reason it's not a situation we're in, but just to give you a little background, we had originally banked with First Republic way back when we were started, before my time, before Sean's time. I wasn't here when the choice was made, but I know First Republic was known for high quality customer service, local bank. I'm sure attractive investment returns on the cash that was left in the bank. Unfortunately, First Republic was one of those banks we all read about a couple of years ago that got basically went under.
Gotta remember what happened there, just because I don't want to jank on First Republic, because we had Silicon Valley Bank they literally went under. And I mean, they started a catalyst, and all the regional banks then were sort of impacted, because when the people were taking their money out of that bank, it began like a run on the small other local.
Yeah, I don't mean nothing. I'm not blaming
Yeah,
First
yeah.
Republic.
So
but
it
it's
was,
fact.
well, so it's, I mean, smaller regional bank, they suffered because of just proximity to Silicon Valley Bank in region and everything. So anyway, we managed through that situation, and JP Morgan bought them, which is how we ended up with JP Morgan, right?
Mhm.
Yeah, before you were here, Rick, sorry.
Anything else?
No, sorry. No, I think it's important
It
because,
is.
we were very responsible in who we hired and why. They were a local bank. And, I don't want them to have like us be disparaging them in any way.
No disparaging,
Yeah.
just so they went under. JP Morgan effectively acquired the bank, and our account basically transitioned from First Republic over to JP Morgan about a year and a half ago. As we do with a lot of our large procurement decisions, we periodically go through a request for proposal to see what else is out there, sort of kick the tires. So we did that in November, and here we are meeting with you to sort of discuss, do we want to make a change and go to River City, which is one of the 2 finalists, or do we want to stick with JP Morgan as the incumbent? Depending on the answer to that, if we decide we want to make a change, we will bring this to the board likely in March with a transition soon after that.
So are you looking for us to make a recommendation if we want to make a change or not, and then it would go to the board, or if we
Yes.
say we keep it here, then does it
Yeah,
just stay here?
there's no vote
Okay.
requested
Okay.
here. This is really a discussion. Sean and I have debated this a lot and had a lot of detailed conversations. Like a lot of decisions I say in finance, there's no right or wrong answer. And so I think we both feel that JP Morgan and Riverside are very well qualified to be our bank. Obviously, JP Morgan is currently. They're just very different banks. And just to give sort of a high level view, and I put this in the staff report, JP Morgan, I'm guessing most people in this room are familiar with who they are. Probably, I think the largest bank in definitely the United States, maybe even one of the largest in the world. High quality balance sheet, A-rated bank, mature risk management practices, extensive operational infrastructure, a lot of investments in technology. They are going to sort of be the one-stop shop bank. They can do pretty much everything from investment banking services to investment management to sort of core treasury operations, which is what we're talking about here. They have a lot of public entity experience. They bank the county of San Mateo. They bank the state of California, SMUD. They have some CCA experience, not a ton. Obviously us, they're one of our banks. They also bank with MCE. But they do have credit facilities out to several of our peers of up to about $250 million. I think CPA is the largest of those. So they have a big balance sheet that they can bring their sort of weight to any situation. Obviously, there'd be no disruption if we were to retain them because they are the incumbent, and they offered a 1-year fee waiver. River City is a bank, my guess is a lot of you maybe haven't heard of. I didn't know about them before.
I grew up in Sacramento.
Okay, they're
really bad.
they're a local bank. They're headquartered in Sacramento. A much smaller bank, as you can imagine. They're not rated. Their angle is understandably sort of personalized service, flexibility. I think the whole bank is about 150 people. We would have basically a hotline into the CEO, senior executive. So, a much different situation. I'm not going to have a hotline into Jamie Dimon.
Ain't gonna call you back.
I think their most unique attribute is they basically grew up with the CCA industry.
They were the first bank to invest.
They were
in
the first
CCA.
bank.
So
They have a
get
lot of
praise for that.
expertise. They know the space. They know the industry. They have, but most of our peers bank with River City. So that is a very different situation than JP Morgan. They're very mission aligned. They're a small bank, but they don't lend to fossil fuel industry. And obviously they're very familiar and supportive of the CCA industry. They offered very aggressive economic terms to have us move the business, 5-year fee waiver and very favorable interest rates on the cash deposit. So that's a summary of the banks. In our RFP, we laid out 9 criteria that we said we would be using to make decisions. So what Sean and I did was we went through and tried to sort of do our best to rate the banks according to these criteria. We would give only 1 check to each bank because some of these, ability to provide services, both JP Morgan and River City can provide the services, but in our opinion, they weighted a little more towards JP Morgan just given the breadth of experience. But so we sort of went through and ranked all the banks. You can see there's pros and cons. Each is a different value proposition. I think in summary, and then I'll turn it over to hopefully this committee to discuss. It a little bit depends on what we want with a bank. Again, JP Morgan is going to be that sort of gold-plated, do everything bank, large balance sheet. We can go to sleep at night knowing the money's going to be there, likely. Probably a too big to fail bank. It's going to be the easiest, obviously, transition given that they're the incumbent. And
There would be no transition.
There'd be no transition, yeah. Versus River City, which is a smaller, local, relationship-driven bank, more mission aligned, can do all the things we want of a bank, but I think everyone would agree probably not the same capabilities of JP Morgan, but we may not need that. We don't have huge, extensive needs. We're not a high maintenance client, so to speak.
But you do, River City Bank does present a little more like, again, I'm not trying to disparage, but like a Silicon Valley Bank or First Republic Bank. They're just a smaller bank.
They're a smaller bank, so
subject to more vicissitudes of the market and.
There could be some risk there. I hope not. And
No, I
I
would
know
hope
they
not
would
too.
say, but it is a smaller bank. They're not rated. And so there is that angle of, our peers are comfortable bank with them. So I don't want to say that's a huge issue,
No,
but
I agree. It's not, it's just, I'm just.
Yeah.
If you're like pointing out the differences.
Yeah.
I'd love to just sort of open it up to you all and hear.
Is that the last slide?
That's the last slide. Yeah, just 3 slides.
Let's just leave it there. I think I have to give them a great time to ask questions of Nick and Sean and the process. They've gone over it with me, so I'm not going to say too much. I'd love to hear from you guys.
And before we do that, because it's in the staff report, but didn't make it to the slides. There are basically 5 things that I think are worth this group's consideration among all the other things, right? It's, I can't remember, but in the staff report, it's in no particular order. Implementation. So is it worth us kind of upsetting the apple cart, if you will, and going through an operational shift?
Which, by the way, we just went through.
Yeah, we did that 2 years ago. So I'm just gonna, with no comment here, just, so that's one, operational issues. One is the difference in fee structures, not huge, but significant enough. The other is concentration risk, which is something that has come up for River City. One that's important to me, I'm just gonna flag it, is mission and values alignment. We've just gotten through talking about that in the previous presentation and the ESG scores and all of that. So that is an issue that I think we should chat about. And then the other is sort of ability to provide credit facility. Because this year, we will be needing a significant credit facility to handle our financial services payment to the CPUC. That's going up to what, about 60 million, we think, 40?
I think 45 or something. like that,
45
but
million
from
or
like
so. Which is essentially like an escrow account that we have to fund with the PUC in the event of we have to return customers. Not likely to happen, but we got to post it. So those are the 5 things that, in my view and in our view, we'd love for you guys to focus on.
Can both of them provide the credit facility?
Yes, River City has said that they can go up to $100 million. JP Morgan has over $250 million, up to $250 million, some of our peers, so they clearly have more bandwidth, so to speak.
Any comments, Tom?
Okay. What I do for my tiny little company is I have 2 banks. I have an operating account, basically a checking account, in one bank. And I have a reserve account, basically a savings account in a second bank. Just so that if one of them ran into trouble, I could call on the other. Never had to do that, so it's probably I've probably created a bigger administrative burden for myself than necessary, but it's just a.
Good risk management, yeah.
Yeah, would it make any sense to do something that, so question number 1 is, would it make any sense to do something like that?
I mean, that's kind of what we do with these guys, right?
Yeah.
So we have our commercial operating bank, and then we have our
Sweep it
out longer term financing bank. So the question would become, and I would ask this to the staff, is do you feel like you need 2 operating account banks? Do you feel like you need a second?
It's an interesting question. I will just give you a data point. MCE did just that.
Okay.
They were banking with River City, I believe, I don't want to, and had a lot of cash with them, and we're growing, they're bigger than us. And got a little nervous, I think, maybe it was during the First Republic days,
Yeah.
and ended up opening a second account with JP Morgan, just for that reason. There's additional hassle, costs, complexity, but they felt it was a risk that was worth mitigating through.
Do they have actively managed portfolio like?
Yeah, they have, this is just their banking
Okay, they're
relationship.
banking. Okay, that's very.
Well, I mean, I gotta say, JP Morgan has, what, a century and a half of history of, hanging in there and working through major financial disruptions. So on a purely dollars and cents security point of view, hard to go wrong with JP Morgan. But I just don't, I don't know River City Bank. I mean, the description sounds really good, but I just. don't know.
Yeah.
I mean, I would defer to your expertise on this, but the one thing that I'm kind of like internalizing is that we're about to go through some incredibly bad economic times. We have economic leadership at the national level that could be running the country and the economy, I mean, between tariffs and really erratic Fed policy into the ditch. And one of the things I would fear is having a regional bank compared to a national bank is that if everything does go up in flames, which one is going to be making it through the other side? And I guess I have kind of a cataclysmic view of the Trump administration in terms of where things are going. And if things really do go belly up in the country, and you can kind of see some signs of that, then where is this money better positioned if there's suddenly, like a Great Depression type event or something like that. So, I mean, I hate to be negative, but I think you're probably, good with a smaller regional bank until you're not. And then when you're not, you're like, oh, geez,
Right. I mean, we just went through that once, right? Like we
Yeah.
just went through that with
First Republic.
First Republic.
And that was isolated. It wasn't a systemic thing.
No, and they were like more like a River City Bank. They checked more of those boxes, which
Mhm.
when we were first starting, and again, we swept everything into the bigger actively managed accounts, PFN and everybody, so we had reduced the risk that way. But I appreciate those comments.
But again, I would say I would defer to staff and your expertise. I don't know anything about this stuff.
Any thoughts?
Yeah, really quickly on the RFP, was there anything that would have prevented like a not for profit from applying for this, like a credit union or a CDFI?
Anyone could, yeah, we tried to go, I mean, as wide as we could, so anyone could apply. We didn't get credit unions apply. We do have one sort of technical need. The interface between PG&E, Calpine and ourselves requires some technology. So we had one bank, Heritage, who submitted and they couldn't meet that need. So I think there is some technological capabilities that were required, but we opened it to anyone, so.
Okay.
It's a good question.
Yeah, and I guess the other, aside from just the national scene being so up in the air, I also know that we're poised to do some growth too, right? And so just thinking about those two things, I think it makes sense to go with somebody like Chase who can provide us, you said $250 million.
Well, that's what they did for one of our peers, so I don't
Yeah,
want to
our
speak
largest
for
peer.
them, but they have obviously a big balance sheet, so if anyone.
They have a big balance. Yeah.
Yeah, so I think that makes sense to just stick with JP Morgan for now. And also if we can revisit this in a few years, right, where I'm glad we have an ESJ policy, right, that we're keeping track of that with our own portfolio, but maybe something worth looking at in a few years once things stabilize.
Yeah, something that's kind of here, implementation, but is that it is no small feat to transition our organization to a brand new bank. And there are always risks in that. There's transition risks, there's nuanced vulnerability and risk when you're moving money around and changing from bank to bank. If we were at River City and everything was going great and we weren't having a problem, I probably wouldn't headache you to go to JP Morgan either. So we just happen to be here, and this exercise is really one in fiduciary management, which is saying we're gonna look, as you say, Elmer, every 3 to 5 years, we're gonna look at our audit relationships, we're gonna look at our banking relationships, we're gonna look at our investment relationships. And our responsibility here as finance and audit is to do the micro review. So the board, we don't have to do all this at the board level. And I'm very comfortable with our organization that came in here. And I'm comfortable with JP Morgan Chase. And there are elements of a big bank like that. They were, caught up in the Epstein scandal, right? Like they were the banker for Epstein. But the way I look at it is we can also then, as we're not an enormous client, but we're a big client. And it gives you an opportunity to say, hey, Chase, don't do that nonsense. Like that's not in our value system. So it does give you an input in a way to sort of say, we want you to represent our values in your banking as well. And, you can use that to influence and hopefully help guide the principles that organizations use. We're one of a million clients, but nonetheless, you can only if we're not a client, we have no say at all. So I don't worry too much about that.
That said, I mean, and this is to me the differentiator with River City. I think JP Morgan's fine. We've done just fine with JP Morgan. Like, there's no diss on any of this. To me, the huge differentiator, and I think the only reason, in my view,
Mhm.
we would consider shifting is the mission vision alignment. Because otherwise, big, small, they're different, but they're both qualified. But the differentiator is in this vision, mission vision alignment. If there are other ways that we can achieve that,
Exactly.
that's fine, but I want for all of us to just be clear about that, because it's also really important to some of our constituents.
It is important, and what I would say in particular,
Customers.
some of our former CAC members and things have pointed this out. I think we do a really good job on mission vision alignment with our other 400, with our big $480 million portfolio we were just talking about today. I think we do a really good job there. I think we as an organization do a good job on our procurement and, our labor agreements and everything. So I don't find this to be so problematic because of everything else we're doing. And we also have a fiduciary responsibility to operate the business as the best possible way.
Mhm.
And I think having the staff having just gone through this, you guys have been really taking a forward-looking focus on what we're going to talk about next, which, or you talked about, which is our bond offerings that we've been doing, our prepays, which have generated money to the organization. The only thing we could maybe do is they've given us a 1-year deal. These guys gave us a 5-year deal. Maybe we go back and JP Morgan and ask them for an 18-month deal or a 2-year and just say, hey, economics of it, we're going to keep you guys. We want to stay with you, how can you, what can you do to help
I'm
us?
happy to ask. I didn't want to ask until we knew this was going that, if that's.
But I think that's a reasonable ask, like we stay with the bank and we ask them to
meet it.
To maybe meet that, say, here's what the economics of the competitor were. What can you do? How can you do it better? They may not. I won't say too much on public negotiations here, but I would leave it to the discretion of the staff to at least go back and say, hey, we'd like to work with you and that, I think that gives you kind of the final tick to say, commercial terms move over.
And if not, we move.
Exactly, and if not, we leave. So anyway, would everyone be amenable to that
There is some
resolution?
public comment.
Yes, may I please have public comment? I
I saw something come
couldn't
come up
see
in
it,
chat,
Nelly,
Nelly.
so
Yes, we have one public comment I'm promoting to panelists now.
please. And we'll reconsider based on public comment and then make a final decision.
Hi, everyone. My name is Rosa Kuchicha. I am the director of River City Bank's Clean Energy and Public Sector Banking Division. Very nice to meet some of you virtually and good to see some familiar faces. I just wanted to really just make sure that you guys knew that I was here and available for questions. I think a lot of the discussions that you guys have are very robust. There are a lot of differences and pros and cons when you're considering switching a bank. Obviously, I'm biased and would love for you to join River City Bank. And so I thought I would just show up. I'm here available for questions. There's a couple of things that I wanted to just address in terms of, kind of the important things that Sean mentioned were kind of the key issues. And so one of the things is kind of obvious. Yes, we are what we like to call a big little bank. And so there are some benefits to that, including Nick having direct access to our CEO. But if you get a hold of Jamie Dimon, that would be pretty cool too. And so that's definitely how we stand out. I do want to address I think there's some heartburn, not just from your guys's particular experience with, having banked with First Republic Bank when they went through their failure. I personally was shocked when First Republic failed because they were known as a very robust banking franchise. And I think it's an important distinction to note that their failure had nothing to do with credit quality. It had everything to do with their interest rate risk management, which was found lacking. And it's something that at River City Bank we take very seriously. And since the bank failures of 2023, bank regulators have been looking at interest rate risk management and kind of ensuring that, where banks are hedging matches with where the market is and that they're not taking undue bets against, what the direction of the Fed is, which is what really happened with Silicon Valley Bank, First Republic Bank, and there was another bank, Signature Bank, that failed all around the same time.
And Rosa, I hate to do this to you, but we have a limit on public comment of
Oh, I'm sorry.
2 minutes. So unfortunately, I have to adhere to that.
Sure.
Are we up? Is 2 minutes up?
Wait, 2 minutes is up,
Okay.
but do you have a concluding 10-second, 15-second?
Yeah, I just wanted to
I
note
do
that
I do want to say as chair that I'm really grateful that you came and appreciate that you came to listen to the, again, the situation. It's really, really nice.
yeah, definitely. I'm sorry. I didn't realize there was a 2-minute limit and I was rambling on
Yeah,
about
that was our fault. I
nerdy
should
bank
have
stuff.
said.
And so just in conclusion, I wanted to let you know that your money would be safe at River City Bank. We do collateralize all of our public funds in accordance with government code. And we do have FDIC insurance. And we would love the opportunity to work with Peninsula Clean Energy and continue expanding our clean energy and public sector division. So with that, thank you guys.
Thank you.
And if there's
Thank
any
you.
questions, I'm happy to answer them.
Thank you. Thank you, Rose. I appreciate it. All right. Any other members of the public? No, we're good. That was very nice. I do think that one thing this exercise has brought about, and Tom, you make a really good point, which is we have JP Morgan, and I think we should maintain and continue to keep a relationship up with River City in the sense of like connecting with them and talking to them. And if there ever comes a point where we are, a little, you feel like we're big, we've got this, or you feel like we have other banking needs that they
Totally.
could address better than the big bank. It's a great suggestion, Tom. And I think what I'd like to say is like we've signed off on them as a bank that we could use and we would be happy to use if the need arises that the staff would have an ability to work with JP Morgan and you could, I think you can see the evidence here is that they're both highly qualified banks and could do the work. I think the big issue right now is if we were starting brand new, I could understand you might go with River City Bank. I think we've just finished a big transition and the transition risk is mitigated if we continue to stay and then do as Tom suggested, have another organization in the
something we
wings
can look
that
at.
might.
I mean, I think that one of the best things, other than the mission vision alignment, clearly River City has that edge, but the CCA experience, just being able to tap Rosa and her team, been around the industry forever. In our meeting, she mentioned a few things. I was shocked she knew or the uniqueness. So it's been someone we definitely want to stay in touch with.
Yeah. I think it's great. I mean, I think we're just basically saying, we'll give our stamp of approval to both organizations. It sounds like staff is fine and colleagues are willing to continue with JP Morgan, but no one would be adverse if staff said, hey, we have an opportunity to work with River City on this or that.
If the commercial terms were better, sure.
Yeah.
I mean, maybe you leave the operating account with JP Morgan because it's already set up and, and you create in effect, a savings account with River City Bank that would be a low volume, something where you don't have a whole bunch of transactions going
Yeah,
through.
and the line of credit could work with the line of
Yeah.
credit too.
Mhm.
Yeah, I mean, there's something to think about here with all of this. So I'm really pleased took a look and I'm really happy we're taking our responsibility on this seriously. Is that enough for staff to go on?
Yep,
Right,
so-
perfect.
Seemed unanimous.
Okay, great.
Brianna, sorry.
Sorry, Brianna.
All right,
I
one
know
last
we're
item.
running out of
Right,
time, but
well-
I can be quick.
Oh, yeah, perfect, fine.
So Q2 review, which is a great quarter because it's halfway through the year, so it's a great data point. I will be quick because I know we're near time, but the punchline is we are on track.
Mhm.
So I almost don't want to spend more time on it, but I will. I'll go through the
Pop up a
standard,
couple.
I'll go through the standard pages, which you've seen, and I'll try and be quick. The first thing is load, which drives both revenues and costs. We've continued throughout the year. This is a story I said on the first quarter, the September year-end quarter. We continue to be below our budget. A lot of this is driven by weather, which obviously we can't control. We had a really mild summer, and we've continued to have a mild year. And so you can see the graph on the right, the actuals to budget, to the actuals to last year. We continue to be below last year and even below budget and even below last year slightly, which is a little rare, again, driven by weather. The energy power resource team is refining their forecasting. I've said this before, and so what I mentioned, we're about to kick off our budget process for next year. So hopefully going forward, we'll be closer to budget. This impacts revenue as well as costs. This is just our revenues. The top table, this is going to be the same format you'll see in a bunch of pages. The top table is the Q2 only, so only 3 months of data. The bottom table is the year to date, so 6 months of data. I like to focus on the bottom table because you can have variability month to month, even quarter to quarter, but over a 6-month period, it's more of a trend. You can see I've put a box on the right, our variance to budget. We are about $15.8 million below budget, and that is almost entirely due to load, which is the factor I said before. So it's $6 million lower in sales, and as you saw on the previous page, 5.7% lower in load. And so that's driving the revenue decline. There's also, you'll notice, a decrease from last year's numbers of about $25 million. That's largely due to the rate decrease we implemented last year. The beginning of last year, so a year ago. And so customer savings means lower revenues. On the cost of energy, same format. I'll focus on the bottom table. This is how we like to categorize our various costs. Cost of energy, as you all know, is our largest by far cost category. About $300 million for the full year, $150 million or so for the half of the year. We bucket into energy, which is sort of the electrons, capacity, which is resource adequacy, which you've all heard of, and then the REC and GHG free attributes, and then other. And then we budget a contingency. We don't have an actual contingency. You can see for the 6-month period, we are $12.4 million below budget. A lot of that is driven by the load. So load impacts revenues, less revenue coming in, but it also means we don't have to buy as much power. And so similar story here. There's some other cats and dogs. I know Sean makes fun of me for using that, but nothing in the spirit of time, nothing really huge. We haven't had to use our contingency. That's there for, big heat events, rare occurrences. So through at least the 6 months, knock on wood, we haven't had to use it, and hopefully we won't have to use it for the back half of the year.
Nick, can I ask a
Sure.
question? So if we're procuring, we always have sort of a delta where we're not quite matched, and we're matching, we procured, say 95%, and we're matching that we're sort of fiddling around that little bit.
Yep.
What happens if we just over procure and demand is way lower than we think? Do we just offload that?
Yeah, we sell it in the
Okay.
market.
Got it.
We try and optimize it
Yeah.
We try to
Yeah.
optimize it, yeah.
Definitely.
So we have a very dynamic,
all the time.
our situation is very dynamic where we're working, our staff is working sort of minute by minute, day by day, month by month, whatever, to anticipate and strategize with load and offloading what we
Exactly.
to
And
someone
we're
who's
also
under.
hedged.
And we're hedged.
So we
yeah.
have the double layer.
Yeah, okay, I just,
Yep.
that dynamic situation is really important to understand.
So this is sort of the full income statement, change in net position. Again, there's a page on Q2, but in the spirit of time, I'm going to go to the next page, which is the 6-month data period.
Mhm.
So this is the top, and it's the same format. You can see the revenues you can see, and I put the box on the right. We already talked about this, $15.8 million below budget. Cost of energy, also $12.4 million below budget. You net those out and we're $3.3 million less than budget. So pretty close. On the operating costs, these are the costs that I'd like to think, control a little more, not all of them. But on cost of energy, we're largely beholden to the market, but these are our sort of operating costs, consulting, legal, salary costs, marketing expenditures. Again, we can't completely control these every month, but we have a lot more control than the cost of energy. And you can see there, which is, I think, good news, we're 4.7 million below budget. So we've really had done a good job managing those costs. Most of that 4.7 is driven by programs. You can see that's 3 million of the 4.7 is programs. That's sort of a weird situation as CFO. I'm always trying to control costs, but programs is the one area where we actually want to spend money. That's our goal, to get this money in the hand of customers. And so this isn't necessarily a great story. We don't want to spend it, haphazardly. But we have seen some delay in our programs, which I know Raphael's briefed you all about, on our home upgrade program. And we'll continue to see that variance for the back half of the year. Hopefully next year it rectifies, so to speak. Non-operating income, that's really a code word for the interest income that we just had Carlos talk about. We earned $10.8 million through the first 6 months. We had budgeted $7.5 million. We can't forecast what interest rates are going to be. They've been hot. They haven't come down as much as we thought. And so there's positive variability there. You net all that together, and we are $4.7 million favorable to budget. So good news on a $250 million revenue business. So I'd like to think, it's not all me. Sometimes better be lucky than good. But I think, rest assured, I think we're doing well for the first 6 months. For the next 6 months, we have the big rate decrease that I mentioned about. So our revenues are going to decline significantly for the next 5 months. Actually, at this point, we budgeted for that. That was expected. But we will see the change in net position to be negative for the next half of the year.
Good news. Any questions?
One more page. I've got one more page. Cash.
Cash on hand.
Cash on hand. We have continued. So this is the 4 buckets of cash. You can see we've got money at the bank, as you talked about. That's cash. That's actually cash. That's at JP Morgan. So we try and target between $15 and $20 million a year. You can see at the end of the year it was 18.9. And then we've got the 3 asset managers that I mentioned before: Camp, PFM, and then Chandler, who you heard about today. Totals about $500 million. I will caveat that number is going to decline from here on out. And so we just drop rates by 47%. We're going to see this number probably end at the end fiscal year with probably around $420 million. And so, and we'll use that in the next year.
And remind everyone, our policy of adjusted days cash on hand, or cash on hand.
Our policy of adjusted days cash on hand, which has some nuances, is minimum of 180 days and a target of 250. And so that's what we're targeting. So we are above that number, but we expect that to decline over the next 6 months or 5 months.
And 2 years.
Over the next 2 years.
Yeah, it's going to come down.
Yes.
And so if we're getting $10 million in interest, and that's say like not going to be present in a couple of years, for instance, we're projecting out to have a deficit then? Is that,
No.
Or are you adjusting that for long-term forecasting if the interest goes down?
Yeah, so for the 5-year forecast, there's a lot of revenue costs, but we are accounting for lower interest income in the out years. 1, because the cash balance is going to go down, and 2, we don't expect to earn that 6% that Carlos got us.
So this is kind of the good times, I guess.
Yeah, I mean, the thing about it is the days cash on hand of $506 million cash and cash investments. Our job is, we're not hoarding money. Our job is to, we have a pretty simple business plan.
Sure.
Give electricity at the lowest price we can. Some of that is what the rating agencies need in order to give us the better ratings, which helps us on some other work we do. But part of it is really to make sure we can stabilize our business so that when we go into these more volatile and challenging times, we've been sort of, saving the good.
Yeah.
And you can see it's really hard for us to get that money even invested into the community. So even last year with like our grants, we all did community grants to the cities by per capita. So every city received a per capita community grant. that they could invest in whatever. In fact, by the way, I meant to tell you, Sean, we need to get a report out on what we,
We will.
yeah, we'll have a
That's
fun
planned.
report out for
Mhm.
what everybody did. So, you know, there's sort of, this is all sort of in the big 10-year plan that these numbers will start to reduce. We've saved them up so we can reinvest them back into maintaining the business model that works.
So we're gonna be meeting with you here in a minute. So we're gonna go much deeper into this
Yeah.
because there's also a rate stabilization fund,
Well,
which allows us to move money and basically have it available. It's a rainy day fund that is coming.
Mhm.
The 47%
Starting to
drop in
rain.
rates.
it's starting to rain.
All right.
Okay, so
Um,
you'll go over that. This looks really good. I mean, Nick, well done, you and your staff. And you're feeling good about your staff and everything, right? You've
What
got,
staff we talking
no, you
about?
have one person,
I'm
don't you?
just kidding. Yes, Haley is,
One is
I mean, I
she's
have
out on
someone on
maternity
who does risks, which is part of this committee's responsibility. It was not on the agenda today. And then we have someone who does rates, who you heard
Yeah.
about, Justin. Haley is my point person on finance and
Yeah.
budgeting.
She's really good.
Fortunately for her, she's been on maternity leave, but she
Oh.
comes back the
In
end of this
March.
month.
Oh, okay, well, congratulations to
So
her.
it's been the Nick
Well,
show.
the Nick show. Thank you, Nick, for taking
That's
on
okay.
all the
Oh,
responsibility. Nick's done a really good job. Yay, yeah. Okay, so we'll
Thank you,
go
Nick.
on to item, and we had no public comment, right, on the budget? No public comment on the budget.
Is there something?
And then Jen, is
Jen, you
there
got
a
about
last
2 minutes.
wrap up here?
I'm going to be so quick. I
Yeah.
promise. So essentially, item number 8, we do have a couple of slides, but this essentially mirrors the board action to allow our audit and finance committee to meet remotely, entirely remotely. So what we need is a vote if this committee wishes to approve that. And the second thing that we would need is a conversation that doesn't have to happen today, but an eventual conversation about the schedule for in-person meetings. So if we'd like to do a cadence of in-person meetings where everyone would come in as they are today, we could do that. But SB 707 does allow this committee to meet entirely remotely. We will have always an open space for the public to come with staff present.
And members can come as well, right?
Absolutely.
So-
Yes, it's
so I
an
think
option.
The benefit of this is that anyone who wants to participate, Tom, if your mother has, if you have a crisis, if someone has a work crisis, a crisis of some sort, we don't have to go through the procedural elements of, you know,
Quorum issues.
AB for this, that, the, blah, 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 and then having people critical, whatever. Like, we can just let everybody know I'm gonna be online or I'm gonna be here. Like, my personal preference is I'll probably come here. And I think when I'm running the meeting, it's easier to run it here with everyone. And if we have a guest, it's more appropriate and easier. But I would, and if anybody wants to come, I think it is great to meet, but if you have work obligations or other things and it's easier for you to join us on the Zoom here, I think that works. So I would personally support this. Do we have any members of the public who have comment or thoughts on this? No, none? Okay.
Nick?
Yeah.
We have,
Sorry, Sean, we do need a vote on that item.
Yeah, we will.
okay, but I just want to
Okay.
clarify, because you asked us, well, maybe it's 2 things. If there is a meeting that we know we want to be here for, I would recommend that it's our budget meeting,
Yes,
and I believe that's May,
Yeah.
correct?
and I
So
may not be.
maybe
Okay.
maybe we do both with one action.
So let me ask you, what would be the benefit of designating something in person versus just having them all be remote with the option to get here?
No one will come in person, so I think there was a desire to like once in a while to
Okay,
get
so
together.
May 11th.
Don't miss out on the dangers.
Yeah. What am I gonna do with all that?
We're all
good
gonna
food?
lose
No,
some
I-
weight.
To me, it would be okay to, schedule all of them as, remote meetings like this, but just encourage everybody to, if there's an important one where there's real issues that need to be kicked around, just encourage everybody to come if they can. If they
Yeah.
can't, then, they can.
Yeah, I think as well, given that this is in the middle of a workday compared to like a nighttime meeting, this is really inconvenient for me to come in.
Totally
today,
get
like
it.
right now.
Totally.
And
Could you do remote more conveniently, right?
remote is more convenient. I mean, I think there's also a value of being in person. but I wouldn't want to be forced to come in person if I had,
Everything.
to, you know, I
Every single
mean,
time.
you know, it's really easy if you're retired to, you know, just,
Yeah.
oh, yeah, I don't have anything going on in my
Or you
life.
don't
Let
have
me
kids,
show
or
up.
you have
or-
your, I mean,
But
you
like
could be.
I had to drop my son off today. I mean, I have childcare, I have work, I have everything else. Not saying I wouldn't be in person. I probably would try to come in person. But depending on where you are in the county, this is also pretty, it's a long drive.
Yeah, and it's gonna get
Good
longer
point.
when we
Forget-
move together
So-
on
That's
true.
this too. So could we do this? Could we just say they'll all be remote? I know I won't be here. I probably won't even be on the June meeting only because I'm going to be out of the country. And it just is so hard. So I would
That's fine.
defer to one of my other colleagues to run the meeting. But Tom, you can run the meeting. You're designated vice chair of the audit and finance. Is everybody okay with that? Tom being vice chair of the audit and finance, he's good.
Sure.
You're perfect. So you'll run the meeting. And the one meeting, the budget meeting is May 11th. Is that the one, Nick?
Two of
Yeah,
them.
May 11th,
May and
yeah.
June.
Okay, and I won't be here in June, but May will be the sort of nuts and bolts working meeting, so if people could make that meeting, that would be great. I will be in person. I will come in person to everything. And then let's just let hybrid isn't quite as easy, but it works. We're a small committee. This isn't 25
Yeah, it's
people.
fine.
Yeah, I don't like hybrid if I can be in person.
Yeah,
But,
but
you
I
know, I
totally
mean,
get
at
it.
the same time, if something were to come up where, you know,
100%.
so.
And it's so much more convenient than having to do all the procedural,
So
Should we vote on it?
someone needs to
Yes,
make
we
a
should.
motion.
please.
So
Want to make, move by Elmer, second by,
I'll second.
okay, Mark, all those in favor?
No,
Aye.
no,
Aye.
no, 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 no,
Roll
hold
call.
on.
Roll call
Just
vote.
confirming
Thank you.
public comment.
Oh, we
Yep.
did do public comment.
We did do public comment. We do need to do a roll call vote, and then just to clarify the motion, it is just to approve, to clarify if this is what I understand, it's just to approve remote meetings pursuant to the SB
Yes,
707.
exactly.
Okay.
Okay, roll call vote.
Belmont,
Tom McKeon, aye.
thank you. Burlingame,
Yes,
East Palo Alto,
Yes.
Los Banos,
Yes.
Redwood City.
Yes.
Okay, the motion carries unanimously. Thank you.
okay, fantastic. Thank you, Nellie. Thank you, Jen, for helping us get this and looking into it. This is gonna make a big difference for people to be able to participate.
Yeah. Thank you, Chairwoman.
Yeah, no problem.
Thank you all.
That is great. No committee member reports, I take it? Unless anybody has anything particular. Yeah, please.
East Palo Alto path, at our last meeting, we did we approved a lighting study, which may be an
Nice.
opportunity for PCD to participate at some point. East Palo Alto has terrible lighting, and we're budgeting about 4.5 million to replace most of the lighting in the city.
Great.
Perfect.
And so, you know, it's kind of an exciting opportunity, but a lot of that's going to be more efficient, brighter lighting, but also more newer and more, you know,
Strategically placed.
more efficient lighting. So something kind of peripherally related, but I saw that PCE has been working with South San Francisco.
And San Bruno.
So
Those are those member agency energy
Those are your
grants.
member agency energy grants. So I think we
Which-
gave you money. So if you've held some aside for it, hopefully that would be
okay,
great.
interesting.
Yeah.
So perhaps
those
we'll
were-
put it.
That's how they
Brief you
were
on that.
funded.
What's
They
that?
We'll brief you on that next.
All right.
Yeah. I have to make a phone call to
We're
Len
good.
Matterman. Can I do it right here?
I
or
think,
in
are
there?
we adjourned?
Yes, we're
Not
adjourned.
till we officially say we're adjourned.
Okay, we're officially adjourned.
Wonderful.
Thank you.
Thank you.
Say hi to Len for
Thank
me.
you, everyone.
All right.